I'm Charlotte McLeod with investingnews.com, and here today with me is Danielle DiMartino Booth. She is CEO and Chief Strategist at QI Research and the author of the book Fed Up, an insider's take on why the Federal Reserve is bad for America. Really good to have you here. Thank you for being here.
Thank you for having me again. Good to be here.
Of course, always good to be catching up with you. As we were saying before we turned the camera on, there's so much to go into. But I thought, because we, of course, know that you're always keeping a close eye on the Fed, it would be good to start there because we just had the latest meeting last week. I think, as expected, rates were left unchanged, and it seemed like the meeting overall didn't seem to make a lot of waves. But I thought to ask you anything that you would pull out that you think investors should be aware of.
So I did find it rather intriguing that the Fed has decided a little bit earlier than I think what I and the street had been anticipating, that they were going to be reducing the roll-off of treasuries from their balance sheet. I think that was kind of the one unexpected that came out of the meeting. So I also try and look to the opposite side of that, and that is that they're going to maintain the pace of their mortgage-backed securities roll-off, which is something that I had been advocating for 12, 18 months here. So I am pleased to see that they're going to continue at least down that path to get out of what we referred to when I was inside the Fed as credit easing, trying to target a particular area of the economy. And we know that Fed actions really did result in higher home prices than we would have otherwise, all else being equal. But again, it was the balance sheet announcement that I think was the unexpected.
Okay, good to pull that out. And then on the note of interest rates, it looks like they are still on track for 2 further cuts in 2025. Although there's pressure from Trump to cut further. So do you see them staying on track with those 2 cuts or anything else you're looking at there?
So I do see the pace of layoffs and bankruptcies in the U.S. economy as probably going to put the Fed in a tight position going into May. We've got 2 non-farm payroll reports before they meet on May the 7th. And I think that because the unemployment rate is just a rounding error shy of being at 4.2%, that there is a risk, a very tangible risk, given, again, all of the layoffs, store closures that we've seen in 2025 and the economic fallout, not just in the public sector, but more so in the private sector, that the Fed's going to be at its 4.4% year-end unemployment rate target a lot sooner than it foresees, such that, the president could be right here. We could be seeing quite a few more than 2 interest rate cuts this year. I foresee maybe 4 or 5.
Yeah, that'll be something to keep an eye on. And I think maybe let's talk a little bit more about bankruptcies, because I think that for those who are following you on Twitter or X, they'll know that you've been tweeting about some of these big bankruptcies. So what's happening there? Is there a cycle here that we can look at to know what's coming? What are your thoughts on what we're seeing?
So right now in the month of March, we're trending towards 23 large bankruptcies. Large is defined as liabilities are 50 million or more. For heaven's sake, we saw 3 in a 24-hour period with 100 million or more in liabilities. But that number 23 is critical if we do indeed see that number for the month of March, which is almost over here, because that's the highest that we've seen since August of 2023, which was the highest in the post-pandemic era, and actually takes us back to 2010 before we see another month where we saw that many large bankruptcies. So we're definitely seeing a credit cycle play out here in the U.S. economy, whether we want to call it that or not. We're seeing that financing is drying up for companies, and that's forcing them into the Chapter 11 proceedings.
Wow. And going back to, this meeting, we had talked, I think the last time was in November, and we spoke about the possible clash between Trump and Powell and how that was perhaps building. Do you see that playing out further as we proceed into 2025?
So there's actually been a lot less out of the White House than I think many of us had anticipated in terms of Trump being vocally anti-Fed. There's probably a lot to be said for the calming agent of Treasury Secretary Scott Bessent and what appears to be a decent working relationship between the new Treasury Secretary and Chair Powell going forward. I think that has to do also with the balance sheet. The reduction of the quantitative tightening is maybe Powell getting it a little bit into Bessent's camp. So I think the criticism has been less than what was feared. And I would hope for more of that to come.
Yeah, it seems like Powell has kind of flown a little bit under the radar. So we'll keep watching and see how that plays out. I think in last week's meeting, Powell did really highlight the uncertainty, though, that is related to what the Trump administration is doing. And a lot of that relates back to tariffs. So it is quite difficult to talk about the whole tariff situation because it's essentially changing from day to day at this point. But broadly, could we get your thoughts on tariffs? Is this something that's going to dissipate? Are we headed to a full-out trade war? What are you thinking?
So I do think that every day that passes by, we get a little bit more nuanced trade policy, a little bit more focus and detail on what the tariffs are going to look like. As long as we continue to see progress in the sense of, automobiles are going to be excluded. And these are some of the more onerous and difficult tariffs that would have been imposed on the U.S. economy, imposed in Canada, imposed in Mexico. As long as we can see a continued dissipation and a more targeted approach towards the tariffs, I think that fear factor could begin to come down. Anything can change at any time. And I think that is why Federal Reserve officials were so united in their voiced concerns about the potential for tariffs to reignite inflation. But if we do go by the 2018, 2019 playbook, inflation actually fell over that period unexpectedly. And the greater drag as a result of reduced global trade was on U.S. economic output. There was a greater drag on growth.
Yeah, that was definitely a topic that I hoped we could touch on because, of course, there's been so much talk about how tariffs might be inflationary. And in your recent work, you talk about how it actually looks like we're headed toward a disinflationary environment. So, of course, there's a lot to unpack there. But can you share the basics of how you arrived at that conclusion?
Well, the most important input to inflation is the wherewithal to handle higher prices, and that is a paycheck. So in the sense that Americans fear that their income is going to be declining in the coming year, and how that is showing up with what CEOs of corporations are saying when they're reporting their earnings, whether it's the CEO of Walmart Corporation or Lennar, the home builder, saying we're having to discount homes more than we had anticipated. That really is a reflection of layoffs as they move through the economy and aggregate income coming down and not able to pay for higher input costs, even if they're imposed. And that's the critical distinguishing factor here. It's not so much that tariffs would not cause input costs to rise. Nobody can deny that. It's an effective tax. The critical factor is whether or not those increased costs can be passed along to end consumers. And so far, what we're hearing from corporate America, the answer is no, that they're not able to pass those costs along, that Americans are being very careful with their discretionary spending and reducing spending on goods and services at the same time in order to shoulder the cost of essentials.
Yeah, I think it's a really interesting perspective and good to look at it with you. And I like how I was reading one of the pieces that you wrote, and you talk about this distinction between what the data tells us and narrative. And I know narrative is so easy to get sucked into. So any thoughts on how people can avoid that when they're looking at all this information out there?
Well, it always helps to be aware of the entity delivering the news, or the entity saying, I think inflation is going to be high because of tariffs. Is this a great big hedge fund that happens to be positioned favorably if treasury yields were to rise based on this fear factor, as opposed to seeing it actually manifest in the data? So you have to be very wary and aware of real-time metrics, what prices actually being charged are. My favorite example, I was in the grocery store on Sunday and I bought a dozen eggs for $2.99. And that has nothing to do with what the media has been reporting about egg prices. So again, if you're a consumer, if you're somebody who's watching the headlines, if you're a smaller investor, do what Warren Buffett says that he's done his entire career and go kick the tires. Go see what things are actually costing. I'm hearing anecdotes of people seeing their auto insurance premiums begin to come down. Again, that goes against the narrative and everything that we're hearing. We're hearing automakers saying that they're having to increase their incentive spending. That means that we can't afford higher car prices, regardless of what happens with tariffs in the automobile sector. If you can't afford to pay the higher prices, if your paycheck is shrinking, if you're working as a Lyft driver because you lost your job, then you're worried about the cost of your rent, and you're worried about the cost of your grocery bill and what you're paying at the gas pump. You're not even concerned with what a vacation might or might not cost, because you can't pay for that anyways. So kick the tires, be on the ground, do your own homework, and don't necessarily get sucked into the narrative that either the media or large investors are pressing for their own purposes.
Yeah, I really like that. As in, people can go out and they can take a look for themselves as something you can do. So really good to go into that. And so again, going back to our conversation this past November, you had told us that the US was already in a recession. So curious to hear more about that, and then how this disinflation scenario then plays into that.
So we have indeed seen one after another downward revisions to 2024 payrolls. That process is nowhere near its end, and yet we see the numbers continue to come down. We saw Challenger Gray and Christmas announce 172,000 layoffs for the month of February. So it appears that the layoff cycle is indeed accelerating into 2025. And again, the biggest determinant of prices and prices that can or cannot be paid is what your paycheck is. And what we're seeing is average weekly earnings have stagnated starting in September and begun to fall on an inflation adjusted basis. That's the real data. That's what we have to pay attention to, especially when the unemployment rate has ticked up from 4 to almost 4.2%. And the Fed's year end target for that rate is 4.4%. It looks like we could easily get there with the March and April payroll reports that precede the Fed's next meeting, which is May the 7th.
Okay. So we've talked, I think, quite a bit about some of the economic concerns in the US, but I think for many people, they're looking at what's going on in the stock market and what's happening there. Is this a bubble? Are we going to see a come down there? What are your thoughts? How are you looking at that?
So every time you see a correction in the stock market, you have to ask yourself, especially when there's a quick rebound after, is this a dead cat bounce? Is this the beginning of a more protracted trend? Most of the time in the history of the markets, it really is a dead cat bounce, and we end up opposite thereof. Most of the time when we see a correction, you do see stocks continue on their upward trajectory. But that is certainly not going to be the case as what I call the recession recognition trade starts to filter through. And that's when you start to pay attention as an investor to companies' ability to afford to keep their dividend intact, to what cash flow is, to what sales and revenue growth is looking at, because those are a lot more difficult to manipulate compared to what companies are reporting as earnings, especially when earnings expectations are coming down. It's easier to beat a lowered bar, but that the same cannot be said for what revenues are being collected by companies, what their cash flows are. And I think that that's what investors have to be very attentive to. And one of the reasons that we've seen a rotation into more defensive areas of the stock market that do indeed pay dividends.
Yeah, I think that goes into another point that I wanted to touch on with you is, what should investors be doing in this situation? So is that the right move to go into these more defensive plays right now?
I think that that's certainly what the tea leaves are telling us. And that is what corporate America is telling us. And until we see kind of a protracted turn where, and the best time to be investing in the stock market for the long term is when companies are expanding their payrolls. There is no greater vote of confidence in the future than hiring new employees. And so that is the signpost that we should look for. It's very easy to pull up Google and see that the searches for unemployment insurance have absolutely gone through the roof in the last few months. That's a sign that layoffs are continuing and that the stock market valuations are continuing to reflect, you know what, now's a better time to be defensive, because as we say, valuations don't matter until they do. And when you start to see corrections, that's a reflection of the fact that the valuations actually are counting.
Really good to touch on that as well. And on the note of paying attention to what's actually happening versus what you're being told. So we have Trump who's telling us we're going into this golden age of America. If you had to characterize where we're heading, how would you put it?
So I do think that if Trump and Treasury Secretary Scott Bessent are able to put the United States fiscal standing on sure footing going forward and reduce deficit spending, reduce the U.S. debt, that we could be at the precipice of a golden age for the United States economy. That being said, there is no such thing as a free lunch, and there will be a price to be paid along the way. And I'm not defending the president in any way, but he has said that there is going to be a period of transition for the U.S. economy. Treasury Secretary Bessent has said that the United States economy may be pausing, maybe coming to a period of a slight setback, not using those words. But I think what they're trying to say is that there is going to have to be a journey in order to get to a better place. Most politicians blink and end up going back on their commitments to making the government more efficient. One of the examples that we do have to look back on historically, however, is the episode of Ronald Reagan in the beginning of his presidential term. There was indeed a devastating recession that occurred there in 1981. And there was a large reduction of the federal workforce that had been built up during the Carter administration that Reagan came in initially and pared back. And we did go into recession. But when you ask the average American civic science history student what they remember about the Reagan administration, the first words out of their mouth are not recession. And so I think that that's something we have to try and keep close to ourselves is perspective. So if this is going to be a proverbial, and I'm blue in the face from saying it, short-term pain for long-term gain, then so be it, because we do have prior episodes in U.S. history that we can look back on where it was okay in the end. We paid a price, but the price was worth what we paid.
Yeah, I think memories are short for sure. So, and it's useful to look back at what do people actually remember. So that will be something to watch as well. Just as we're getting to the end here, I'm almost afraid to ask, but you're very deep in the data. Any other things that are keeping you up right now that you would want people to be aware of?
So I think when it comes to watching the data, you have to closely track, I think, job openings, layoff announcements, bankruptcy announcements, store closure announcements. These are the things that are happening on the ground. And I am very much anticipating and looking for a turn in a lot of these series. But I think that at this time, the more real time you can be in your monitoring of the data, the more informed and prepared you're going to be as an investor.
Okay, really good to talk about that as well. Any final thoughts that you would leave people with?
At a time when many American households are pulling back, it's definitely the onus is upon U.S. households to be very careful in their financial planning and make sure that they shepherd their nest egg very carefully and make sure that they've got money for a rainy day.
Okay, well, I think that is a really good place to leave it. Thank you so much for taking the time to go over all of these different points. I found it really useful.
And thank you. Thank you for having me today.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Danielle DiMartino Booth with QI Research.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.